is a dip toward the low of the selling climax that occurs on significantly diminished volume, proving that supply is exhausted. When a trader buys after this confirmation, his stop is placed just below the low of that secondary test. The logic is the same. The trade is based on the evidence that selling pressure has disappeared. A move below the low of this successful test would contradict that evidence and thus invalidate the reason for the trade. The next scenario is buying on a breakout. After a stock completes its jump across the creek, moving out of its accumulation range, and then completes a successful backup to the edge of the creek, the trader has an excellent low-risk entry point. The stop loss is placed just below the low of this pullback, which is often the former resistance line of the trading range, now acting as new support. If the breakout is genuine, this new support level should hold. A failure of this level, with the price falling back into the old trading range, would be a strong indication that the breakout has failed, and the position must be closed. Finally, let us consider buying during an established uptrend. After the initial breakout, a healthy trend will proceed in a series of advances and reactions. Opportunities to enter a long position often occur during periods of reaccumulation, or stepping stones, or at the conclusion of a normal healthy pullback. In these cases, the stop loss is placed just below the low of the most recent reaction. A healthy uptrend is defined by a series of higher highs and higher lows. A decline that violates the low of the previous reaction breaks this pattern and is the first sign that the trend may be ending. The stop placed at this level ensures that the trader exits the position as soon as the stock's bullish character comes into question. Now let us examine the rules for placing stops on short positions, which are trades initiated with the expectation of a price decline. The logic is the perfect mirror image of that for long positions. In every case, the stop is placed just above a valid point of technical resistance. The best opportunities to sell short occur at the end of a period of distribution. The most powerful of these is after an upthrust. An upthrust is the final manipulative move above the resistance of a trading range, designed to trap bulls at the top. When a trader sells short in confirmation of an upthrust, that is, after the price has failed to hold its gains and has fallen back into the trading range, the stop-loss order is placed just above the extreme high of the upthrust itself. The thesis for the short sale is that the breakout was false and that heavy distribution occurred at that high. If the price were to subsequently rally and move above the high of the upthrust, this thesis would be proven wrong, and the short position must be immediately covered. Another excellent short-selling opportunity comes after a secondary test of the high of a buying climax, especially if this test occurs on lower volume, indicating that buying demand is exhausted. When selling short after this sign of weakness, the stop is placed just above the high of this secondary test. The next scenario is selling on a breakdown. After a stock falls through the ice, breaking the support of its distribution range, it will often experience a feeble rally back to the underside of the old support line. This is the last point of supply, and it is an excellent low-risk point to initiate a short sale. The stop-loss is placed just above the high of this rally, which is the old support level now acting as new resistance. If the breakdown is genuine, the price should not be able to reclaim its old trading range. A move back above this level would signal that the breakdown was false, and the short position must be covered. Finally, when selling short during an established downtrend, the stop is placed just above the high of the most recent rally. A healthy downtrend is defined by a series of lower lows and lower highs. A rally that violates the high of the previous rally breaks this bearish pattern and is the first sign that the trend may be reversing. Placing the stop at this logical point ensures the trader exits his short position as soon as the stock's weak character is no longer in evidence. In every single one of these scenarios, for both long and short positions, the stop loss is placed not at an arbitrary price, but at a specific technical point that is directly linked to the logic of the trade. The final piece of this strategic puzzle is the integration of the stop loss placement with the potential profit of the trade. This brings us back to rule number 4. The anticipated profit must be at least 3 times the risk. Before any trade is even considered, the Wyckoff analyst must perform this critical calculation. The process is a three-step sequence. First, based on a thorough analysis of the chart, the trader identifies a potential trade and the logical entry point. Second, he identifies the logical danger point for that trade, as we have just discussed, and determines where his initial stop loss must be placed. The distance in points between his entry price and his stop loss price constitutes his risk. Third, he must determine the potential reward. This is done by projecting a logical price objective for the move. The most scientific way to do this, according to Wyckoff, is by using the point and figure counting method to measure the cause that has been built during the accumulation or distribution phase. This count provides a reasonable estimate of how far the subsequent move can be expected to travel. The distance in points between his entry price and this price objective constitutes his anticipated reward. Finally, he compares the two figures. If the anticipated reward is not at least 3 times the size of his defined risk, the trade must be passed over. It does not matter how promising the setup appears. If the risk/reward ratio is unfavorable, the professional trader moves on and waits for a better opportunity. This single discipline is the mathematical foundation of long-term trading success. It ensures that the profits from the winning trades will be large enough to overwhelm the small, controlled losses from the losing trades. It frames the stop loss not as an afterthought, but as an integral and indispensable part of the trade selection process itself. It is the denominator in the all-important risk-to-reward equation that lies at the very heart of trading as a business. Once a trader has mastered the foundational principles of capital preservation and the art of placing a correct, logical initial stop loss, the nature of his work shifts. The initial phase is defensive. It is a discipline focused on survival and the prevention of catastrophic loss. But after a trade is initiated and begins to move in a favorable direction, the trader must transition from a defensive to an offensive mindset. His new objective is to manage the position in a way that maximizes the potential gain while systematically protecting the profits that have already accrued. This is a profound psychological challenge. The public's natural tendency is to snatch a small profit with nervous haste, driven by the fear that it will disappear. The professional, however, understands that the greatest profits come from riding a sustained trend for a substantial move. Richard Wyckoff's rules for managing a stop loss are designed to instill this professional discipline. They provide a logical, unemotional framework for letting profits run, while ensuring that a significant portion of those profits is never given back to the market. The cornerstone of this profit protection strategy is the trailing stop loss. This is the mechanism by which a trader can patiently follow a trend for weeks or even months, surviving the inevitable normal reactions while systematically locking in gains. The method is logical and precise. In a healthy uptrend, which is defined by a series of higher highs and higher lows, the rule is as follows. After the stock makes a new high and then completes a normal, healthy reaction on diminished volume, the stop loss order should be moved up to a point just below the extreme low of that reaction. This process is then repeated for the duration of the trend. Each time the stock surges to a new high and successfully completes a subsequent pullback, the stop is trailed up behind it, placed just under the new higher level of support. The psychology and logic behind this technique are flawless. By placing the stop below the most recent reaction low, the trader gives the stock ample room to breathe. He is allowing for the normal, healthy pullbacks and consolidations that are a necessary part of any sustained advance. He is not choked out of his position by the meaningless minor fluctuations. At the same time, this method forces the market to prove that the trend is definitively over. For a healthy uptrend to be broken, the stock must, by definition, violate the low of the previous reaction. By placing his stop at that precise technical point, the trader ensures that he will be automatically exited from his position at the first logical sign that the trend's primary structure has been compromised. This removes the emotional turmoil and guesswork from the decision of when to take a profit. The trader does not have to wonder if a reaction is minor or major. His trailing stop makes the decision for him, based on the market's own action. A critical milestone in the management of any trade is the first move of the stop-loss order to the break-even point. After a trade has been entered and has moved favorably by a sufficient amount, the first objective is to move the stop to a price that covers the original entry price plus all commissions and taxes. This creates what is commonly known as a risk-free trade. The psychological benefit of this single action cannot be overstated. Once the initial capital is no longer at risk, the trader's mindset is liberated. He's no longer playing with his own hard-earned capital, but with the market's money. This clears his mind of the fear of loss and allows him to focus with much greater objectivity on the primary task at hand, managing his accumulating profit. This single step is a crucial part of transitioning from a defensive posture to an offensive one. As a profitable trend matures, the trader is faced with a strategic decision on how to ultimately exit the trade. Wyckoff acknowledged two primary methods. The first is a manual exit, where the trader closes the position himself when the chart shows a clear, logical sign that the advance is culminating. This could be a buying climax, an upthrust, or any other sign of significant distribution. The advantage of this approach is that it may allow the trader to secure a price that is closer to the absolute high of the move. The disadvantage is that it requires a high degree of skill and is subject to emotional error. A trader may misinterpret a simple consolidation as a top and exit too early, missing out on a further substantial advance. The second method is the automatic exit, which is simply allowing the trailing stop-loss to do its job. The trader continues to trail his stop up under each successive reaction low and remains in the position until the trend finally breaks and the stop is triggered. The advantage of this approach is its mechanical discipline. It removes emotion from the exit decision entirely. While this method will, by definition, never capture the absolute high of the move, it guarantees that the trader will capture a very substantial portion of the overall trend. For most traders, especially those who are still developing their judgment, this systematic, unemotional approach is the far superior choice. It is the embodiment of Wyckoff's principle to let the profits run. Wyckoff also discussed several advanced professional-level concepts related to the use of stops. One is the practice of placing stop-loss orders at odd fractions. He observed that the public and many amateur traders have a strong tendency to place their orders at even, whole numbers or at the half-point marks. Floor traders and specialists, knowing this, could at times be tempted to briefly push a stock to these obvious levels to trigger the clusters of stops. To counteract this, Wyckoff advocated for placing stops at the less common fractions, such as 1/8, 3/8, 5/8, or 7/8. Placing a stop at 62 and 7/8 instead of at 63 provides a small but meaningful buffer that can often prevent a position from being shaken out on a meaningless dip. He also warned of the dangers of using stops in thinly traded markets. In stocks with a small floating supply and a wide spread between the bid and asked prices, a stop order may not be executed cleanly. A stop placed at 70 could be executed at 69 or even 68 in a fast market, as the price gaps down between trades. For this reason, he strongly advised that traders, especially those who rely on close stops, should confine their operations to the active liquid market leaders where executions are swift and reliable. For the highly experienced operator, Wyckoff also described an advanced technique known as the double stop for reversing a position. For example, if a trader is long 100 shares of a stock at 61, and he determines that the critical support level is at 59 3/4, he might reason that a break of this level not only invalidates his long position, but is also a signal to initiate a new short position. In this case, he would place an order to sell 200 shares at 59 3/4 stop. If triggered, this single order would close out his 100-share long position and simultaneously put him short 100 shares, instantly reversing his stance in the market. This is a tool for the agile expert trader, but it illustrates the flexibility of mind that Wyckoff sought to cultivate. For those who wish to truly master the lessons discussed here, it is essential to study them from the source. Please take note of a unique new edition of Richard Wyckoff's masterpiece, How I Trade and Invest in Stocks and Bonds, by Max Davidson. It has been meticulously adapted for the modern trader, complete with explanations that make Wyckoff's timeless wisdom more accessible than ever. For anyone who wants to truly absorb the lessons we are discussing, this adapted edition is an indispensable part of your library. The link to this book is located in the description of this video. In conclusion, the stop-loss order in the hands of a Wyckoff analyst is far more than a simple safety net. It is a complete system for the professional management of capital and risk. The philosophy of the stop-loss instills the business-like mindset necessary for survival. The art of its initial placement, based on the logic of the chart, ensures that trades are only taken when the odds are heavily in the trader's favor. And the science of its management, through the disciplined use of the trailing stop, provides the mechanism for capturing the large trend-following profits that are the hallmark of all great operators. The mastery of this single tool, its philosophy, its placement, and its management, is the single most important step in the journey from being an amateur gambler to a professional market operator, one who can survive and thrive in the financial markets for the long term.